All right, we are getting ready. This is Be the Boss of Your Money, late edition. How pumped are you? I am so pumped for this. Let's get the show on the road in 3, 2, 1. Hey there, it's Mitch Goldberg. Welcome to my live stream. This is your post-market show about the markets, the news you need to know. We dissect it all. It's about personal finance, planning. We get into it. We take a deep dive into all this good, fun financial stuff. We're doing something a little different. We're in a little bit of a later time slot today. I don't really feel like I own the post 6 o'clock time slot. 4:30 is my usual time, but sometimes life comes up, things get in the way, and you have to roll with the punches. Isn't that what it's all about? Rolling with the punches. Today we're going to talk about this. Okay. Today we're going to talk about tomorrow, because tomorrow morning starts what I think will be the determination of where this whole market goes, because I feel like the pressure's building. So tomorrow we've got the big CPI number, the Consumer Price Index inflation figures. We've got JP Morgan tomorrow, and then for the rest of the week we have bank earnings, and more bank earnings. And we're going to take a look at all the stuff coming up. Plus, we're going to dissect today's action and what are the big stories. So here we go. Let's roll the quick intro, and we're going to have a really good show. So stick around. And if you have any questions, you know what to do. Ask me in the comments. I love hearing from you. It's the best part of this. Here we go. All right. Thank you so much for joining me. I'm Mitch Goldberg. You're watching my post-market show. I call it Be the Boss of Your Money because I share with you the lessons I've learned in a career that is over 30 years long and continuing. And when you put it all together, I've learned so much, and I just feel like I'm overflowing with knowledge, and I enjoy sharing it. I really enjoy sharing it, like even if nobody watched me, and sometimes I feel like that, I would still do this show. Okay. But seriously, folks, while you're out there, give it a thumbs up, tap the love button, the heart button, the thumbs up button, whatever, the celebration, whatever platform you're watching on. Let me know you're out there. I appreciate the encouragement. I appreciate words of wisdom in the comments, and of course, most importantly, I really, truly welcome your questions. That is the best part about this. So you probably didn't expect me to come on now. This is almost 2 hours later than my usual time. I feel like I own the 4:30 time slot. I mean, this might sound like hubris, but I feel like nobody in my network is going to dare do something consistently at 4:30 Monday through Thursday, because that's my time slot. So while I'm out of here, if I'm on someone else's time slot, then check me out later. I won't be offended, but I think it's important to be consistent when you are a content creator, educator, and entertainer. Yeah, I like to think of myself as entertaining. I mean, who doesn't, right? I mean, I could be a little funny. So what are we going to talk about today? There are a couple of things, and I want you to know this. Tomorrow morning, I've got all my notes right here. The important things, the salient facts, inflation. Okay. Now, the International Monetary Fund has lowered its forecasts for global growth. Basically, every economist out there, from every major firm to every central bank, everyone out there is cutting their growth forecasts for the rest of this year and next year because of inflation and supply chain problems. You can't get chips. You can't get cars. When I say chips, I'm talking about semiconductor chips, not potato chips. Okay. You can't get so many things. And as a result, what's left is either going to be very expensive, so prices will go up, that's just the law of supply and demand. Supply goes down, demand stays the same, prices go up. I don't think this is a demand problem. We're coming out of a recession very slowly in fits and starts. It really depends on, you know, COVID cases surging or not around the world, especially in the United States. And then when they start to go down, we start to feel like a surge is coming. But overall, there are just such huge supply constraints, in particular energy and semiconductor chips. So let's just talk about this because I don't think a lot of people really understand what's going on with energy. Okay, so first of all, okay, I know a lot of people like to get into the politics of why gasoline is up, but let me just start by saying that gasoline is higher than it was pre-pandemic. It's certainly a lot higher than when we were at the peak of the pandemic when gasoline was about $1.19, $1.18 national average. But that's because usage, supply literally like just fell off a cliff and we had such a surplus. If you recall, during the pandemic, a barrel of oil actually went negative. It went below zero to negative. Could you imagine that? Oil contracts were zero. So, but let's get into today. First of all, China cut back on ordering energy supplies to help deal with the slowdown from the pandemic. Then they get hit with a surge, and China has basically run through their coal stocks much quicker. So, what do? They literally start paying up for coal. They start actually using oil. Like they're literally burning crude oil for energy, and China's having rolling blackouts. They're shutting down factories, not all day long, but rolling blackouts. They're asking citizens who work in office buildings, who work on the lower floors, if they could take the stairs instead of the elevator to conserve energy. In the meantime, Europe is now going through a shortage of natural gas, not for a supply constraint, but for a Russian constraint. So they're using up coal where they could, but Europe's not really big on coal. They're running out of natural gas. What are they doing? They're burning oil. So China's burning oil, Europe is burning oil, and all of a sudden you have demand for oil going up. It's not just because something happened. The United States is still a huge producer. We're not producing less oil in the last 6 months. We're producing more. Uh, OPEC plus, that's OPEC plus Russia. They have more capacity to put more oil into the market. They don't want to. They're holding back. They definitely want to hurt shale producers in the United States. It's a silly way to think because the shale oil is still there, and if one producer goes bankrupt trying to get the oil because that producer's cost structure is too high, then you'll get a new producer coming in with a lower cost structure, and then they'll just pump the oil. So it's a battle into nowhere. And plus, the other thing is in Europe, Europe relies on a lot of wind energy, and funny thing is, it just hasn't been that windy around the windmills, so they're getting a little bit less supply from wind. So you put it all together and you've got a really tough situation for energy, and it's driving up inflation, and it's causing people to be miserable. And you see what a gallon of gas costs, how much it costs to fill up your tank. I think a lot of people are happy to still be working remote because the commutes have gotten to be so expensive, right? All right, so that's what's going on with oil, and I just want to be clear that you understand where this is going. Eventually, China will restock its coal. Eventually, either Russia will produce more natural gas or the Europeans will find another source of natural gas, namely the United States, from LNG shipments, liquefied natural gas. But eventually, everything will balance itself. Are we at a permanently higher plane of natural gas? We could be, and a lot of people have been saying, "Oh, oil is going to go to zero." Like when I recommend an oil stock, I put an oil stock in clients' accounts. Sometimes, I talk to clients about the portfolios, things that we're doing, and they're like, "Well, isn't oil going to go to zero eventually?" I'm like, "No, oil could go up." And the fact is, oil could go a lot higher because as more and more producers leave the industry and we're still using oil, it just means that the fewer producers are stronger and, are can charge more for their products. So it's not what you think. And in the meantime, energy has been on a tear um, for this year. It's one of the best performing sectors, especially as of lately. Okay, so let's talk about another thing in supply chains. Okay, let's talk about semiconductors. Now, I remember, you know, in the early 90s, I got into the industry in 1990, and semiconductor chip stocks was like this new weird cool thing, like semiconductor. Wow, that's like so techy. Now like semiconductors, they're in everything. But that was the sales pitch back in the early 90s, was that everything would have a semiconductor chip. Everything. And not only did it come true, but everything has a lot of semiconductor chips. You take a camera, you take a car, whatever it is, there are chips in anything with a battery or that gets plugged in has a chip. And some products have hundreds of chips, like cars. So Taiwan Semiconductor is the biggest chip foundry in the world, biggest manufacturing plant of chips, semiconductor chips. We call it a foundry. That's the inside lingo. Um, and it takes a lot of water to make semiconductor chips, and they're having a drought there, so that hurts. Um, Cars today require more chips. Chip production was shut down, and it's taking a little while to get it restarted. So that's another problem. It's just that the pandemic caused so many disruptions in terms of shutting down production and then not having adequate production when demand came back. It just it screwed up the whole supply chain of the world, and it's taking longer to fix it. And as a result, it's driving prices higher, driving inflation higher. Now, is this transient, temporary because supply chains catch up, or are we in a permanently higher level of higher prices? That remains to be seen. I think most economists agree that we are at a permanently higher level in terms of wages, in terms of materials, in terms of the cost of everything. But I remember a couple of years ago, people were saying we're never going to see oil go above $40 a barrel ever again. A couple of years ago, one very famous person, uh, a commentator, said we were never going to see oil go above 40 in my lifetime. Well, this person is still alive and kicking, and oil is over $80 a barrel for West Texas Intermediate, and even higher for Brent crude. So don't forget that it's all cyclical. Eventually, supply will catch up. We will build and mine enough products, enough houses, enough semiconductor chips, enough natural gas, enough coal, and then we'll get back into equilibrium. And it'll be a bumpy ride. Look at the price of lumber. Lumber shot up and then it shot down. It's still up from where it started, but it still dropped dramatically. And people just get overly carried away or enthusiastic. And you never know when these changes are going to happen. You just don't know. I mean, we could literally see something happen and oil all of a sudden drops, 30, 40%. And oil had a big dip about 2 months ago. Oil had a big dip and people were like, oh, forget it. I'm out of oil stocks. And now oil stocks are going up. Oil is going up, but oil stocks haven't really moved up yet. And then you look at bank stocks. One ETF that I follow is IAT. That's IAT. It's from iShares. It's a regional bank stocks, exchange traded fund that invests in regional bank stocks. Okay. And this is around 60, but it's still a little bit lower than where it was like 6 or 7 years ago. And it hasn't exceeded that price. And people for a while thought that would never go back up. Now it's almost back to where it was 6 or 7 years ago. And if it surpasses that on a technical, that would be a technical breakout. It could go even higher. So You can't write anything off, and this is why you're not just diversified. Diversification is a strategy that we use to reduce risk, but it doesn't necessarily protect your portfolio from going down in a down market. But if you diversify and if you rebalance, then you're talking about something, I think, very special. You're talking about better portfolio management. Okay. The difference between rebalancing and just diversification is rebalancing doesn't necessarily mean you exit a stock or a position or an asset class completely. It just means you take a little bit out of it when that asset class starts to represent a bigger portion of your overall assets than you had originally planned according to your risk tolerance. I hope that makes sense, but it's really important. All right, so let's go on about a couple of things, okay? Because we're covering a lot of ground, and I'm having a lot of fun. I find this stuff really interesting, and I like to geek out a little bit. So tomorrow, inflation CPI number is expected to be 5.3%. So let's keep an eye out on that. I think there is some upside potential because again, energy is going up, rents are going up, food is going up. So if that comes out substantially higher than 5.3, I'm talking like let's say 5.8, no, the high 5% range. That's going to be a real hit to the bond market, and it'll be a real hit to a lot of stocks. And the stocks that would get hit are what you would expect. You know, your high duration stocks with high valuations that have gone up a lot. In particular, technology is where you find a lot of stocks that would fit that description. So those would go down. Could be good for banks because banks, you know, when interest rates go up a little bit, that's good for banks because banks have so much deposits that when interest rates go up a little bit, banks make more money on your deposits. They're not going to pay you more. Maybe one day they will, but that's going to take a really long time. So in the meantime, when interest rates go up, banks get to make more money, not you. I just want you to know how. I want you to know how it works. I'm not telling you anything you don't know. Okay. Well, maybe I am. And then we have again. We have um, J.P. Morgan's numbers. Now, J.P. Morgan, the last 4 quarters, the last 4 earnings reports, stock has gone down the last 4 times. Thursday, Bank of America is coming out with earnings, and we're going to see how all these banks are doing with trading and wealth management and net interest margins. That's how much money they make on your deposits. That has been down. Bank of America, the last 7 earnings reports, the stock has gone down. All right. So if you didn't buy a bank stock today and you were planning on buying a bank stock, the numbers to me say that, hey, you know, you're probably better off waiting anyway. Okay. Now, Wells Fargo, forget trading it with Wells Fargo. Their trading probably will not be as good as the rest of the industry because they have caps on, you know, lower caps on how much they could trade, how much they could make, how much they could loan, and that's because of regulatory issues. Wells Fargo has just been a regulatory nightmare, starting with their fake account scandal a couple of years ago. I think there was like 2016, and 6 years later, they're still paying for it. They're still in the news for not moving quick enough. So it's all about the regulatory matters and to see if they made progress in fixing up the bank. Right now, it's tough to say. I would have said Wells Fargo is Senator Elizabeth Warren's most hated stock, but Facebook is really giving Wells Fargo a run for its money in which company Elizabeth Warren hates the most. That's it's quite a distinction. Okay. So that's Thursday. Also Thursday, Morgan Stanley. I would say Morgan Stanley is in great shape. From wealth management, it's been a bull market. From trading, from a from a cost perspective. Okay, from a cost cutting perspective, they are in pretty good shape. So I expect them to do well. The stock has been down. It's been going down lately. A lot of the bank stocks have been going down, but Morgan Stanley especially. So because it's been going down, um, I wouldn't be surprised to see an uptick in the stock when the earnings come out. Okay, just because of the way it's been trading, and I'm just saying I wouldn't be surprised. It's not a guarantee in past performance. There's no guarantee of future performance. Yada yada yada. And Citigroup, um, Citigroup is exiting like 13 international markets. Citigroup has been a story about getting their stuff together since the Great Recession, and the stock has been down for the last 6 earnings days. The stock has been down, all six for the last six. Okay, that's what for the last six means, right? And then Friday we have Goldman Sachs, which usually has a mixed report. Their last earnings report, the stock took off like a shot. They toned down earnings expectations based on trading, and this bank is more built on trading than anything else. The difference between like a Goldman Sachs and a Morgan Stanley is that Morgan Stanley has the wealth management division, and it's a massive wealth management division, which Bank of America has also. Bank of America owns Merrill Lynch, and those businesses are typically steadier businesses, reasonably profitable, but very, very dependable, very stable businesses. So that's what's going on this week, and it's going to be exciting. So I'm not looking at these stocks. Okay, I see there's a comment out there already. I'm going to check that out. I'm not looking at these stocks necessarily just to get a gauge of the economy. And these companies will basically tell you, these banks will help you decipher what's going on in the economy, what's going on in the world of finance. But I'm not looking at it through the prism of an up market or a stock, or from an up market or a down market. I'm looking at them more of, do we ride the reopening stocks, or do we ride the tech stocks, the work from home, stay at home screen stocks? And I think you're going to get enough information from the bank companies to figure out which way things are going to go for the rest of this year for sure. Okay, so that's what's going on with those. And again, let's talk about the taper. James, let me show you. Let me put the screen up. Okay, let me pop myself up in the screen, and I want to show you. Sometimes it's important to look at the most important stories of the day. This is by Jeff Cox at CNBC, and Jeff is like one of their top editors. He's just a prolific writer, and he says Fed's Bullard, okay, St. Louis Federal Reserve President James Bullard, advocates for the central bank to get more aggressive with its tapering in case interest rate hikes are needed. Now, some people find that spooky, because the Fed's been saying our timeline to taper has nothing to do with our timeline to raise interest rates. And the timeline to raise interest rates is going to be a lot more stringent or a lot harder to pull off than just tapering. So let me explain. The Fed buys $120 billion worth of bonds every month, every single month. And they want to knock that number down from, let's say, 120 billion to, let's say, 107 billion. They knock it down by 13 billion. Okay. And then the next month they lower it by 13 billion. The next month. So as they keep lowering the number of the dollar amount worth of bonds they buy, it's called tapering. Okay. The Fed is, Wall Street takes it now as, I don't know if you want to say gospel, but the expectation is that the Fed will be done tapering in July of next year, of 2022. And it's expected that the Fed will start to taper next month in November. So that's 9 months. You take 120 billion divided by 9, it's $13.3 billion a month. That's why I came up with 120 billion down to 107 billion. And what Bullard says is he wants it to go even quicker and start a little bit earlier, in case the Federal Reserve has to raise short-term interest rates. The Fed raising short-term interest rates is a much bigger deal than tapering the bond purchases, because the bond purchases were put in place as an emergency measure because of the pandemic and to keep the economy going. It's widely believed we don't need the emergency measure anymore. And it's also a widely held belief in a lot of corners of Wall Street that we should have started this taper like months ago. We're already behind, and it's contributing to the high inflation environment we're in now. And Bullard says we're in a high inflation environment right now, not just because of supply shortages, but because of too much money printing. So if you print too many dollars, the dollars become worth less, which means if they become worth less, you need to use more of those dollars to buy the same goods and services that you bought before, which means you got to pay more. And that's inflation. Is it sticky? Does it stay permanent? So many things. But I do feel like the market is just entering the stock market's entering like this pressure cooker moment, and the stock market needs to break one way or the other. Last thing here. Let's take a look at we're flying through this. Let's take a look at how the markets did today. You could see that on your screen, right? So the Dow is down 117 points. I mean, not a big deal. Listen, when you have a Dow that is over 34,000, 100 points either way, it's not a big deal. But it's the consistent day to day retreats that the market's been having, and the market has shown strength earlier in the day, and then it just gets weak into the close. And that's a sign of liquidation, a sign of investors getting out of stocks. It's ordinarily a sign of a market that looks like it's getting weaker, and the market has been getting weaker, but it just doesn't look as great. Let's take a look at some of the comments out there. At least Bitcoin is up. Yes, sir. I think we go higher until they actually physically change the rates to 2 to 3%. Market goes higher. I think that's a valid opinion. It's often been said that it's really the first few interest rate hikes are not necessarily bad for the stock market, as long as the economy can continue to grow without inflation piling up too quickly. There's so many ifs to what can happen, and that's why making this any forecast right now just it seems harder than usual, if that makes sense. Thank you very much, Felipe. Appreciate that. And we've got to talk. I know I owe you a call. It's just we've got some things going on. We got things right. Nasdaq was off 20 points. No great shakes. No big deal. S&P off a little bit. Gold off a tad bit. Oil was off a drop. Like I know we were just talking about how high oil is. It was only off 13 cents today. The 10-year Treasury continues to stay in the 1.5 range. And you see the VIX, I've been saying if it stays under 20, the market goes up. I think one of the reasons the major averages are only down a little bit is because the VIX didn't go through 20. And this could bode well on a very short-term bounce. All right. Russell 2000 was actually up. See the Russ 2K? You see that? The Russell 2000 is the small cap stock index. I call it the biggest stock market index that nobody follows, but you should, because it's smaller companies are more sensitive to the domestic economy. They get more of their earnings and revenues from the domestic economy as opposed to international markets. And when that goes up, it's usually, it's a sign, not definitive, but it's a sign that says, maybe things are going pretty good domestically. All right. And while we're talking about this stuff, let's talk crypto for a second, and then I'm going to let you guys go because I don't like to go past the 30-minute mark. We could go past the 30-minute mark, but it's getting late. I'm tired. I want to work out later. So let's see. So crypto. Let's see. Here we go. So crypto off a little bit. Listen, Bitcoin just went from like 41,000 when China said we're banning, crypto, to like 58,000. So the fact that a volatile instrument like Bitcoin only went down this much, I don't think it's anything great. And I think the crypto diehards are probably looking at that and saying, like, poof, big deal. Who cares, right? I see a heart out there. Judy gives me the heart. Mwah. Love you, baby. Um, okay, so who else? And Filippo says there's nowhere else to put money to outpace inflation. How to buy equities? You have to buy equities or crypto. Well, yeah, that is the thing. I mean, it's Tina, right? TINA. There is no alternative. So, what are investors doing? They're going into stocks, whether if it's stocks that pay dividends, stocks for growth, stocks for both. They're going into crypto. I think a lot of investors have tried gold and have gotten sick of gold, so they are leaning on crypto even more as their hedge against inflation. There's a lot of things going on, a lot of cross currents. There's meme stocks, which we didn't even get into today. Um, and I feel like right now it's about as uncertain of a period as we've ever had. I mean, going into the holiday season, and we're literally getting we're like warned by the retail industry. You better shop now if you want anything. You better be prepared to pay top dollar for it, and you better be prepared to not even find what you're looking for. It's just a very strange time, and that's why it's hard to make a determination. So here's my determination, though. Let's control the things that we can control. Your personal finance, how much money you invest every month, how much you spend, how much you save, um, being tax efficient, making sure you're taking advantage of where your tax location money goes, between a 401k or a 403b or an IRA or Roth, convert an IRA to a, these things will have as much to do with your future success as whatever the stock market does. The stock market's not always going to cooperate, and that's fine. You can't control that, but there are a lot of things that you certainly could control. Have you updated the beneficiary designations on your insurance policies? Do you have a disability policy? All of these things. Look, I'm not trying to sell you on this, but these are things that you can control, whether if you believe you need to do all of them or not. These are what you can control. You have a child, you want to invest for their college education. I would rather see you invest a little bit now every month than try to invest more later and play catch up, because it's just harder to do. I hope that makes sense. One more from a man Philly. Precious metals are artificially held back. That's why investors are tired. They'd rather own funny money crypto because of this. Yeah, listen, I was talking to a friend of mine the other day in the industry. It's like, what's the deal with gold? And we're like, look, gold is just out of favor now, but gold's not going away. There will come a time when gold starts to go up, above 2000, and then everyone will get excited about it. And then at much higher prices, it'll become like the hot thing to own, and everybody will act like they bought it today. But if you want to own gold, do you want to wait till it gets really hot, hot gold, hot metal? Or do you want to take a shot on something now? And that's up to you. That's a matter of personal finance. And that's about it. So I thank you for watching, and peace, love, and I don't know if we'll be in tomorrow. We've got some things going on tomorrow. We've got my mother's getting a big procedure, so wish us luck. And I don't know if she's going to be staying over in the hospital. I don't think I'll be at the hospital this late tomorrow. So maybe I'll come back to you tomorrow at 6 o'clock. Well, so maybe I'll just take the day off from the live stream. We have to figure it out. But whatever it is, I'll be here. I'll be around. So if you want anything, you need anything, you know where to reach me. Talk to you soon. And buy low, great time to buy physical. It's Philly's opinion. I won't be around, but maybe next week. Cheers. Cheers, buddy. Talk to you guys soon. Bye.